Before we dive in, it is critical to understand that the information in this video is for educational and informational purposes only. I am not a financial advisor, and this presentation is not intended to be a substitute for professional financial, legal, or tax advice. The world of insurance is complex and individual needs vary greatly. You should always consult with a licensed and qualified professional before making any decisions about your financial future or insurance coverage. Your specific circumstances are unique, and what works for one person may not be right for you. He had just traded his combat boots for work boots. After a decade in the Marine Corps, Sergeant Frank Miller was finally home for good. He had a new job, a mortgage on a small house in a quiet suburb, and 2 kids who were thrilled to have their dad home every night. He felt secure. He had his GI Bill for college, his VA loan for the house, and he knew he had life insurance. He'd been paying for it every month for 10 years, that automatic deduction from his military paycheck for something called SGLI. He figured it was like his uniform, it just came with the service and would always be there. He was wrong. 4 months after his final day on active duty, Frank got a letter. It was a cold, bureaucratic notice informing him that his coverage, the $400,000 safety net he believed was protecting his family, had expired. The window to convert it had closed. Just like that, with the stroke of a pen on a form he barely remembered signing during the whirlwind of outprocessing. His family's primary financial protection was gone. If something happened to him tomorrow, his wife and kids would be facing that mortgage, those car payments, and the entire cost of living completely on their own. Frank's story is not a rare exception. It is a silent crisis happening to thousands of veterans every single year. A recent survey suggested that over half of all separating service members are confused about what happens to their military life insurance when they leave. They step out of a world where their housing, their healthcare, and their financial safety nets are largely managed for them, and into a civilian world where they are suddenly the sole architect of their family's security. And the single most dangerous misconception is believing that the life insurance you had in the military automatically follows you into civilian life. Doesn't. That is the exact problem we are going to solve right now in this video. We are going to build your personal intelligence report on life insurance for veterans. We're not just talking about the government options. We're going deep into the private sector options that can often be cheaper, more flexible, and provide far better protection for your family. By the time this is over, you will understand the critical deadlines you cannot afford to miss. You will know how to shop for a policy, even with a service-connected disability. You will learn the difference between term, whole life, and the other options they throw at you. And most importantly, you will have a clear, actionable battle plan to ensure that the people you love are protected, no matter what. You fulfilled your promise to your country. This is about fulfilling the promise you made to your family. Look, I get it. The transition out of the military is chaos. You're trying to find a job, maybe move across the country, figure out your VA benefits, and just learn how to be a civilian again. The last thing on your mind is insurance paperwork. In the service, you're trained to focus on the mission. Your squad, your platoon, your company, that was your focus. Everything else, from your paycheck to your insurance, was largely automated. But now, you are the commanding officer of your own life. You are the supply sergeant for your family's budget. You are the one who has to anticipate future threats and build the defenses to protect against them. And the biggest financial threat to a young family is the unexpected loss of a primary breadwinner. Thinking about life insurance feels complicated, maybe even a little morbid. It's easy to put it on the back burner, but that procrastination is a gamble, and you're betting with your family's future. The system is designed in a way that's almost guaranteed to create confusion. While you're in, you have what's called Service Members Group Life Insurance, or SGLI. It's fantastic coverage for the price, especially for someone in a high-risk job. Simple, it's automatic, and it provides up to $500,000 in coverage. You check a box, the money comes out of your pay, and you don't think about it again. The problem is what happens the moment you separate. The military gives you a 120-day grace period, where your SGLI coverage continues for free. But after that 120 days, it vanishes. It's what I call the SGLI cliff. For your entire career, you've been walking on the solid ground of being insured. Then you transition out, and without realizing it, you're walking straight towards the edge of a cliff. You have a 4-month window to make one of the most important financial decisions of your life, and most veterans don't even realize they're on the clock. Now, the military doesn't leave you completely high and dry. They offer you a path forward. They tell you that you can convert your SGLI into a civilian program called Veterans Group Life Insurance, or VGLI. And for many, this seems like the perfect solution. It's offered by the government, there's no medical exam required, and it feels like a simple continuation of the policy you've always had. It's the easy button. During your out-processing briefs, it's presented as the default, the obvious next step. Just sign here and you're covered for life. But what they don't always tell you in that briefing is that the easy button can become incredibly expensive over time. VGLI premiums increase every 5 years. That affordable rate you start with as a 28-year-old veteran can become a massive financial burden by the time you're 48. They also don't tell you that for many healthy veterans, the private insurance market can offer double the coverage for half the price. This is the core of what we're going to uncover. We're going to put VGLI under a microscope and compare it head-to-head with the plans you can get on your own. We'll look at the real-world costs over a 10, 20, and 30-year period. We'll talk about how things like your VA disability rating can impact your eligibility and your rates. We'll bust the myth that if you have a disability rating, you're automatically uninsurable on the private market. That is flat out wrong. We'll explore how to leverage your veteran status to get potential discounts and benefits from military-friendly insurance companies. This isn't about just getting a life insurance policy. This is about getting the right policy. It's about finding the most effective and efficient way to build a fortress of financial security around your family. A fortress that can withstand anything life throws at you. You've been trained to assess threats, gather intelligence, and execute a plan. We're going to apply that exact same skill set to your personal finances starting right now. First, let's define the mission parameters. The objective is your family's total financial security. Not just for a year, not just until the kids are out of the house, but a permanent, unshakable security. The threat is anything that could take you out of the picture unexpectedly. And the intelligence we need to gather is on the tools available to neutralize that threat. The first piece of intel is a hard one, and it's something a lot of us get wrong. We assume the system that had our back in uniform will have our back in the same way when we're out. We think SGLI, VGLI, and survivor benefits are the whole plan. That is a critical intelligence failure. It's like planning a mission assuming you'll have constant air support, only to find out you're on your own after you cross the line of departure. Let's break down the government-issued gear. While you're in, you have SGLI Service Members Group Life Insurance. It's fantastic. It's cheap, it's automatic, you don't have to think about it. It's your standard issue body armor. It does its job while you're on active duty. But the moment you ETS or retire, you have to turn it in. It's not yours to keep. This is where the first potential ambush is laid. The military tells you, don't worry, you can convert your SGLI to VGLI, Veterans Group Life Insurance. And on the surface, it sounds like a good deal. No medical exam. Guaranteed acceptance if you sign up within 240 days of leaving. Feels safe. Feels familiar. So, millions of us do it without a second thought. We sign the paper, check the box, and move on thinking our flank is secure. But this is where the enemy is hiding in plain sight. VGLI is a form of group insurance. And the single most important piece of intel you need to understand about it is this. Its price is not fixed. The premiums for VGLI increase every 5 years. Let me repeat that. The cost of your VGLI policy goes up automatically every 5 years for the rest of your life. Think about that. When you get out at 25, that $400,000 policy might seem affordable. But when you're 40, the price has jumped. When you're 50, it's jumped again and again. By the time you're 60 or 65, the very time your health might be declining and you need that insurance the most, the cost of VGLI can become astronomical. It becomes so expensive that countless veterans are forced to make a terrible choice. Pay a bill that's bigger than their car payment, or cancel the policy and leave their family with nothing. Let me paint a picture for you. Let's invent a guy, we'll call him Sergeant Miller. Miller gets out of the Army at 30. He's got a wife, 2 young kids. He does the smart thing, he thinks, and converts his max SGLI to a $400,000 VGLI policy. The monthly premium is manageable. He sets it up on autopay and forgets about it. At 35, the price goes up. He barely notices. At 40, it goes up again. Okay, it's a little more, but still doable. At 45, another jump. Now he's feeling it. At 50, the 5-year increase hits, and it's a gut punch. His kids are getting ready for college, the mortgage is still there. And this life insurance policy that was supposed to be his family's safety net is now a massive financial burden. He looks at the numbers for what it will cost him at 55, at 60, and his stomach drops. He realizes he cannot afford to keep it for the rest of his life. He's been paying into it for 20 years, and now he's facing the reality of having to cancel it. right when his family's financial future is most vulnerable. Sergeant Miller fell into a trap. It's a trap baited with convenience and familiarity. VGLI is the easy option, not the strategic one. It's a fallback position that gets weaker over time, not a fortified stronghold. This is why we have to gather our own intelligence on the private sector options. This is where you take control of the mission. In the civilian world, life insurance primarily breaks down into two major categories. Think of them as two different weapon systems, each designed for a different purpose. First, you have term life insurance. The name tells you exactly what it is. You buy it for a specific term, usually 10, 20, or 30 years. It's pure protection. If you pass away during that term, your family gets the full tax-free death benefit. If you don't, the policy expires. That's it. It's simple, it's straightforward, and it is incredibly cost-effective. Term life is your close air support. You call it in for the most critical phase of the mission. What's that phase? It's the period when your financial responsibilities are at their peak. It's when you have a mortgage to pay, young kids to raise, and college tuition to save for. You might take out a 30-year term policy when you buy your first house. The mission of that policy is to make sure that, no matter what happens to you, your family gets to stay in that house and the mortgage is paid off. You might get a 20-year policy when your first child is born, with the mission of ensuring their future is funded through college. It's targeted, powerful, and designed for a specific operational time frame. The most critical piece of intel on term life is that the price is level. If you get a 30-year term policy, your premium is locked in. It will be the exact same price on day one as it is 29 years and 364 days later. There are no 5-year price hikes. There are no surprises. You establish a fixed cost for your defensive perimeter, and it never changes. You are in command of the budget. The second major weapon system is permanent life insurance. The most common type is called whole life. Just like the name implies, this policy is designed to cover you for your whole life. As long as you pay the premiums, it will never expire. It's a permanent fortification. Costs more than term because it's guaranteed to pay out eventually. But it also has another component, something called cash value. A portion of your premium goes into a savings account inside the policy that grows over time, tax deferred. This cash value becomes your strategic reserve. It's a financial asset you can borrow against, or even withdraw, to help with emergencies, supplement your retirement income, or fund an opportunity. It's more complex than term, and it's a longer-term financial strategy. It's about building a permanent asset, not just covering a temporary threat. So let's recap the intelligence report. On one side, you have VGLI. It's easy to get right after service, but it becomes a ticking financial time bomb, with costs that escalate every 5 years, potentially forcing you to abandon your defenses when you're most vulnerable. On the other side, you have the private market. You have term life, your cost-effective air support for specific missions, with a price that is locked in and guaranteed not to change. And you have permanent life, your lifelong fortress that builds its own strategic reserve of cash value over time. Understanding this difference is the single most important step in this entire operation. It's the difference between blindly walking into an ambush and choosing your own battlefield. It's the difference between using the gear you're handed and selecting the specialized equipment that will actually guarantee mission success. Sergeant Miller's story doesn't have to be your story. He didn't have this intelligence. You do. You now know the primary threats and the basic tools available. You've done the map reconnaissance. The next phase is to get boots on the ground and analyze the terrain up close. We need to figure out which tool is right for your specific mission, how much coverage you actually need, and how to get it without getting ripped off. This isn't about guesswork. It's about precision. It's about calculating the exact amount of firepower needed to protect every single objective, from your mortgage to your kid's diploma. Let's start by zeroing in on the target. In the military, you don't just point your weapon in the general direction of the enemy. You acquire a target, you calculate the range, you account for windage. The same principle applies here. We need a precise calculation, a battle plan for your family's financial security. Forget the vague rules of thumb you've heard, like 10 times your salary. That's like saying a rifle is good for somewhere between 100 and 1,000 yards. It's not good enough. We need a system. I call it the target method. It's an acronym that ensures we cover every critical angle of your financial life. T is for total debt. This is your first objective. We need to eliminate every single financial liability that could burden your family. Think of it as clearing a minefield. You wouldn't want your loved ones to have to navigate that alone. So get out a piece of paper or open a spreadsheet. List everything. The big one, of course, is your mortgage. What's the outstanding balance? Then add any other loans. Car loans, personal loans, student loans that your spouse may have co-signed. And don't forget credit card debt. Add every single dollar that you owe to someone else. The goal here is to ensure that if you're gone, your family starts with a clean slate. The house is paid for. The cars are owned outright. There are no nagging monthly payments draining their resources. This isn't just about money. It's about peace of mind. It's about giving them a secure home base, free and clear. Next, A is for after-tax income replacement. This is the big one. This is the multi-year supply line that keeps your family operating. Your paycheck is the lifeblood of your household. If it stops, how long would your family be able to maintain their current standard of living? A month? 6 months? We need to plan for years, even decades. A good starting point is to calculate how much income your family would need until your youngest child is 18 or 20. So, if you make $80,000 a year after taxes, and your youngest is 8 years old, you need to replace that income for at least 10 years. That's $800,000 right there. This isn't about them living lavishly. It's about preventing a catastrophic lifestyle change on top of an emotional tragedy. It means your spouse doesn't have to immediately sell the house or take on 2 extra jobs while trying to raise grieving children. It means the lights stay on, the pantry stays full, and life can continue with some semblance of normalcy. It's the ultimate act of providing, even when you're not there. R is for raising children. This goes beyond just replacing your income. The U.S. Department of Agriculture recently estimated that the average cost to raise a child from birth to age 18 is over $300,000. $300,000. And that's before college. Let that sink in. This covers everything from diapers and daycare to braces, sports equipment, summer camps, and their first car. If you have 2 kids, you're looking at over $500,000 in projected costs. This part of the calculation ensures that your dreams for your children don't die with you. You want them to play soccer? You want them to learn the piano? You want them to have the same opportunities as their friends? This is the fund that makes it all possible. It's a dedicated war chest for their childhood. Then we have G for gifting and legacy. This is where we move from defense to offense. Life insurance isn't just about paying off debts and covering expenses. It can be a powerful tool for building a legacy. What do you want to leave behind? Maybe you want to leave a significant donation to a charity you care about, like the VFW or a local animal shelter. Maybe you want to provide the seed money for your spouse to finally start that small business they've always dreamed of. Or perhaps you want to leave a sum of money for each of your grandchildren to be given to them when they turn 25. This is your chance to make a lasting impact, to project your values and your generosity far into the future. It's about more than just preventing bad things from happening. It's about making good things happen after you're gone. E is for education. We talked about the cost of raising a child, but college is a separate, monstrous expense. According to the College Board, the average annual cost for a 4-year public, in-state university is over $23,000. For a private university, you're looking at over $55,000 a year. That's potentially over $200,000 for one bachelor's degree. If you have multiple children, you see how quickly this adds up. Do you want your kids to graduate with a diploma in one hand and a mountain of student loan debt in the other? Funding their education is one of the greatest gifts you can give them. It sets them up for a life of opportunity, not a life of debt servitude. This part of the calculation is a specific, high-value objective. We are funding their future success. Finally, T is for taxes and final expenses. This is the cleanup crew. It's the stuff nobody wants to think about, but it's critically important. The average funeral in the United States now costs between $7,000 and $10,000, and it can go much higher. Then there are other costs: legal fees, accounting fees to settle the estate, and potentially estate or inheritance taxes depending on where you live and the size of your estate. A good rule of thumb is to set aside at least $25,000 for these final expenses. This ensures that your family doesn't have to dip into their own savings or, even worse, go into debt just to pay for your final arrangements during their most difficult time. It's the last logistical detail, and it needs to be handled. So let's put it all together with a quick example. Let's take a hypothetical sergeant. We'll call him Mike. He's 35, married with 2 kids, ages 4 and 6. He just bought a house. Let's run his numbers through the target method. T for debt. He has a $300,000 mortgage, a $25,000 truck loan, and $10,000 in credit card debt. Total debt, $335,000. For income, Mike brings home $6,000 a month after taxes, so $72,000 a year. His youngest is 4, so he wants to replace that income for at least 16 years, until she's 20. 16 times $72,000 is $1,152,000. For raising children, 2 kids, let's use a conservative estimate of $150,000 each to get them to 18. That's $300,000. G for gifting. Mike wants to leave $50,000 to his alma mater for a scholarship fund. That's $50,000. E for education. He wants to set aside $100,000 for each of his 2 kids for college. That's $200,000. T for final expenses. We'll budget a safe $25,000. Now let's add it all up. $335,000 for debt, plus $1,152,000 for income, plus $300,000 for the kids, plus $50,000 for his legacy, plus $200,000 for education, plus $25,000 for final expenses. Mike's total life insurance need, his mission-critical number, is $2,062,000. Take a breath. Look at that number. For many of you, the number you just calculated for yourself is probably a lot bigger than you expected. Maybe it's 1 million. Maybe it's 2. Maybe it's more. It might even seem impossibly large. And that's okay. That's a normal reaction. We're not talking about buying a car here. We are talking about a plan to financially weatherproof your family for the rest of their lives. The objective is massive because what you're protecting is priceless. The first step is to acknowledge the true scale of the mission. Now you have your number. You have your target. The question that's probably screaming in your head right now is, how in the world can I ever afford that? You're thinking a $2 million policy must cost a fortune. And that's where the next piece of intel comes in. That's where we separate myth from reality. Because getting that level of protection, that fortress wall around your family, is a lot more achievable than you think. You just have to know what kind of armor to buy and where to get it. So let's start with the standard issue, most fundamental piece of armor in the civilian world. It's called term life insurance. And if you only learn one thing from this entire series, this should be it. The name tells you exactly what it is. It's life insurance that covers you for a specific term or period of time. Think of it like a tour of duty. You can buy a policy for a 10-year, 20-year, or 30-year term. During that tour, if you pass away, your family gets a tax-free lump sum payment. A big one. If the term ends and you're still standing, the policy simply expires. Your tour is over. That's it. No payout, no cash value, no complexity. It is pure, unadulterated protection for the lowest possible cost. It's the M4 carbine of life insurance. Simple, reliable, incredibly effective at its one specific job, and affordable for everyone to carry. The mission of term insurance is to protect your family during your most vulnerable years. When is that? It's when your kids are young. It's when your mortgage is at its peak. It's when your spouse relies on your income to keep the lights on and the whole operation running. It's designed to replace your income for a set number of years, so that a tragedy doesn't also become a financial catastrophe. It ensures that your kids can still go to college, that your spouse doesn't have to sell the house, that the life you were building together doesn't get completely derailed. The most common objection I hear is, I can't afford $1 million life insurance policy. And this is the myth I want to shatter right now. Because of its simplicity, term life insurance is shockingly affordable. Let's run some real-world numbers. Let's take a 32-year-old veteran. Let's call him Mike. Mike just got out of the Army, he's healthy, a non-smoker. He's got a spouse, 2 kids under 5, and a new 30-year mortgage for $350,000. His mission is crystal clear. Protect his family for the next 30 years, until the kids are grown and the house is paid off. So Mike needs a 30-year term policy. How much coverage? A common rule of thumb is 10 to 12 times your annual income. If Mike is making $80,000 a year, we're looking at a policy between $800,000 and $1 million. Let's go with a $1 million policy to be safe. So we have a 32-year-old healthy male, non-smoker, looking for a $1 million 30-year term policy. What does that cost? Are you sitting down? For most major carriers, Mike is looking at a premium of somewhere between $45 and $65 a month. That's it. For $1 million of protection. That's less than most people's monthly subscription to streaming services. It's less than a family trip to the movies. It is, without a doubt, the single biggest bang for your buck in the entire financial world. For the price of a couple of pizzas, Mike can ensure that if the worst happens, his family gets a check for $1 million. Tax-free. That money pays off the mortgage instantly. It provides a massive fund for his spouse to live on while they get back on their feet, without having to rush back to work while grieving. It sets up college funds for both kids. It completely removes financial stress from the worst day of their lives. That is the power of this armor. It's not about dying. It's about allowing your family to continue living. Now, what are the downsides? The biggest one is right in the name. It's temporary. If Mike buys a 30-year policy at age 32, it will expire when he's 62. If he's still alive, which is the goal, the policy is done. He gets nothing back. And some people hate that idea. They feel like they wasted their money. But that's the wrong way to think about it. You don't get your money back on your car insurance if you don't get in a wreck. You don't get your homeowner's insurance premiums back if your house doesn't burn down. You were paying for protection, for peace of mind. You were paying for the what if. And if the what if never happens, you won. That's a victory. The other thing to know is that while your premium is locked in for the term, that $50 a month will stay $50 a month for all 30 years. If you want to get a new policy when you're 62, it's going to be astronomically more expensive because you're 30 years older and a much higher risk. That's why it's critical to buy a term that's long enough to cover your needs from the start. Don't buy a 10-year policy if you have a 30-year mortgage and newborn kids. Match the armor to the mission. There's also an important feature to look for. A piece of gear you can add to this armor. It's called a conversion privilege, or a conversion rider. This gives you the right to convert your temporary term policy into a permanent policy later on, without having to prove you're still healthy. This is a huge advantage. It's an exit strategy. It means if you develop a health condition during your 30-year term, you won't be left uninsurable when it ends. You have a guaranteed way to keep your coverage, and we'll talk more about why that matters. So that's term insurance. Simple, powerful, affordable protection. But it's not the only kind of armor out there. There's another category entirely. If term insurance is like renting protection, this next type is like owning it. It's called permanent life insurance, and the most common version you'll hear about is whole life insurance. This is a completely different piece of equipment, designed for a different kind of mission. Whole life insurance is exactly what it sounds like. It's designed to cover you for your whole life. As long as you pay the premiums, the policy never expires. It guarantees a payout to your family, whether you pass away tomorrow or at age 105. But it does more than that. A whole life policy is actually two things combined into one package. It has the death benefit, the money your family gets, and it has a savings component called cash value. Think of it this way. With term insurance, 100% of your premium goes toward the cost of the insurance itself. It's like renting an apartment. Your monthly rent pays for the roof over your head this month. Nothing more. With whole life, it's more like buying a house with a mortgage. Part of your monthly payment goes to the bank for interest, that's like the cost of the insurance. But another part of your payment goes toward the principal, building up equity in your home. That equity is the cash value in a whole life policy. It's a pot of money that grows inside the policy, tax-deferred, at a slow but steady rate guaranteed by the insurance company. And this cash value is yours. You can borrow against it, you can use it to pay your premiums, or in some cases you can surrender the policy and walk away with the cash. Because of this dual function, lifelong protection plus a cash value savings account, whole life insurance is significantly more expensive than term insurance. That 32-year-old veteran, Mike? That $1 million policy that cost him $50 a month in term insurance. A whole life policy with the same death benefit could cost him $800 to $1,000 a month, or even more. It's a massive difference. And this is where the big debate in the financial world comes from. Some experts will tell you whole life is a ripoff. They'll say you should always buy term and invest the difference. Meaning you take that cheap $50 term policy, and you invest the $900 you saved every month into the stock market. And mathematically, over 30 years they're usually right. You will likely end up with more money doing that. But that's not the whole story. Whole life isn't designed to compete with the stock market. It's not an investment in that sense. It's a conservative financial tool for people who want guarantees. The cash value growth is guaranteed. The death benefit is guaranteed. It's for specific long-range missions. Things like leaving a guaranteed inheritance for your kids or grandkids, creating a fund to pay for estate taxes if you have a large estate, or providing money for final expenses so your family doesn't have to. It's a different strategy. It's not about getting rich. It's about ensuring you'll never be poor and that you can pass on a legacy with absolute certainty. So we have two main types of armor. The lean, efficient, and affordable body armor of term life, designed for a specific tour of duty. And we have the heavy, more expensive, but permanent fortress of whole life, designed to stand for a lifetime and beyond. They are not good or bad. They are just different tools for different jobs. And the key to building your family's financial fortress is knowing which tool to use for which task. It's about understanding the mission parameters. And that's exactly what we're going to break down next. A head-to-head battle. Term versus whole life. We're going to put them in the ring, compare their strengths and weaknesses, and help you figure out which one, or maybe even a combination of both, is the right battle plan for you. Alright, let's get these two contenders into the ring. In one corner you have the lean, efficient, and incredibly powerful contender term life insurance. In the other corner, the steady, resilient, built for the long-haul champion. Whole life insurance. This isn't just a simple comparison. It's a clash of philosophies about money, time, and legacy. And understanding the core difference will be the single most important step you take in this entire process. Let's start with the challenger, the one most people hear about first, term life. The name says it all. You are buying life insurance for a specific term or period of time. Typically, this is 10, 20, or 30 years. You pay a fixed monthly premium for that entire term. If you pass away at any point during that term, your beneficiaries get the full tax-free death benefit. $1 million policy means they get a check for $1 million. Period. But, and this is the crucial part, if you outlive the term, the policy simply expires. It's gone. You stop paying and the coverage ends. You don't get any of your premiums back. It did its job and now the contract is over. Think of it like this. When you were in the service, you might have been assigned to a specific mission or a tour of duty with a defined timeline. For that mission, you needed specific gear, specific support, a specific operational plan. Term life is your financial gear for the most critical mission of your civilian life, protecting your family during your highest earning, highest debt years. It's the air cover you need while the kids are growing up, while you're paying down the mortgage, while your spouse relies on your income. The number one, undisputed advantage of term life is its affordability. It is, by far, the most cost-effective way to get the largest amount of coverage. A healthy 35-year-old veteran, a non-smoker, could potentially get $1 million of coverage for a 20-year term for somewhere between $50 and $80 a month. Let me say that again. $1 million of protection for less than the cost of a family cell phone plan. This is why it's the go-to for so many young families. It allows you to buy the amount of coverage you actually need to replace your income, not just the small amount you think you can afford. The second advantage is its simplicity. There are no moving parts. It's a straightforward contract. You pay X, your family gets Y if you die within Z years. There are no hidden fees, no complex investment statements to decipher. It's pure, unadulterated protection. But like any strategy, it has its vulnerabilities. The biggest one is right in the name. It's temporary. What happens if your 20-year term expires when you're 55, and you realize you still want or need coverage? Well, you'd have to apply for a new policy. But now you're 20 years older. Your health might have changed. That new policy is going to be drastically more expensive, if you can even qualify for it. The other drawback is that it's a pure expense. If you outlive it, the money is gone. Some people are psychologically bothered by this, feeling like they lost the money. But you wouldn't say you lost money on car insurance just because you didn't crash your car. You paid for the protection and thankfully you didn't need it. That's the mindset for term insurance. So that's term life. Massive protection for a specific time, at the lowest possible cost. A tactical tool for a defined mission. Now let's turn to the other corner of the ring. The heavyweight. Whole life insurance. Whole life is a type of permanent insurance. And again, the name tells you the story. It is designed to cover you for your whole life. As long as you keep paying the premiums, the policy will never expire. It doesn't matter if you live to be 75, 95, or 115. That death benefit is guaranteed to be there for your family when you pass away. But here's where it gets completely different from term. Whole life is not just a death benefit. It's a two-part product. It's protection and a savings or investment vehicle, all bundled into one. A portion of every premium you pay does two things. Part of it pays for the cost of the insurance itself. The other part goes into a built-in savings account called the cash value. This cash value is guaranteed to grow over time, tax-deferred. Think of it like a savings account that you can't easily raid for weekend trips or a new TV. It's a forced discipline savings plan. Over decades, this cash value can grow into a substantial sum of money. And here's the kicker. You can access this money while you're still alive. You can take out loans against your cash value, often at a reasonable interest rate, and you don't even have to pay them back. The loan amount would simply be deducted from the death benefit when you pass away. You can also surrender the policy entirely and walk away with the cash value if you no longer need the insurance. The military analogy here is different. This isn't a temporary mission. This is building a permanent forward operating base for your family's financial future. It's a strategic long-term asset. It's always there, it's fortified, and it slowly but surely grows in value and capability over time. The main advantage of whole life is that permanence. The peace of mind knowing that no matter what, there will be money left for final expenses, to pay off any remaining debts, or to leave a legacy for your children or grandchildren. It's a promise you can make that you know will be kept. The second advantage is that cash value. It becomes a financial multi-tool. Need a down payment for a house? You can borrow from it. Need to fund a business opportunity? It's an option. Need to supplement your retirement income? It can be structured to do that too. And the premiums are typically level for life. The price you pay at 35 is the same price you'll pay at 75. It never goes up. So what's the catch? You knew there had to be one. The cost. Whole life insurance is exponentially more expensive than term life for the same death benefit. That $1 million policy that cost our 35-year-old veteran $60 a month with term? For a whole life policy, that premium could easily be $800, $900, even over $1,000 a month. It's a massive difference. This is the single biggest reason why most people, especially young families, can't afford the amount of whole life coverage they actually need. The other drawback is its complexity and relatively low returns. The cash value growth is often conservative compared to what you could potentially earn by investing in the stock market over the long term. This leads to one of the oldest debates in personal finance. Buy term and invest the difference. The argument is, why not buy the cheap term policy and invest that extra $800 a month yourself into a low-cost S&P 500 index fund? Over 30 years, that separate investment account would likely grow to be much, much larger than the cash value in a whole life policy. So who wins the fight? The answer is, it depends on the mission. It depends on you. Term life is for the what-ifs. What if I die unexpectedly while my kids are still young and my mortgage is huge? It solves a temporary but massive problem. It is for income replacement. Whole life is for the when. It's a certainty that we will all pass away eventually. Whole life is designed to be there when it happens, providing liquidity for estate planning, covering final expenses, or leaving a guaranteed inheritance. It is for legacy creation. For many veterans, the right answer isn't choosing one over the other. It's deploying them both strategically. You might use a large, inexpensive 20 or 30-year term policy as your main force, protecting your family during those high-risk years. At the same time, you could have a smaller whole life policy as your foundational asset, a permanent base that will be there no matter what to cover your burial costs and leave a little something behind long after the term policy has expired. This isn't about one being good and the other bad. They are different tools for different jobs. A hammer isn't better than a screwdriver. You just need to know when to use each one. Understanding this fundamental difference between temporary needs and permanent goals is the key. But what if there was a way to blur the lines? A policy that offers the permanence of whole life but with the flexibility and potentially lower costs of term? That's a whole different kind of animal. And that's where things get really interesting with universal life insurance, our next contender to step into the ring. Universal Life, or UL, is the chameleon of the life insurance world. It's designed to adapt. If term life is like renting an apartment and whole life is like buying a house with a fixed 30-year mortgage, universal life is like buying a house with a flexible, adjustable rate mortgage that also has a line of credit attached. It's more complex, it has more moving parts, but that complexity gives you an incredible amount of control. At its core, a UL policy unbundles the three main components of permanent insurance that are all baked together in whole life. You have the cost of the actual insurance, the part that pays out the death benefit, you have the policy's administrative expenses, and you have the cash value account. With universal life, these are all separated out, and that transparency is what gives you the flexibility. The biggest, most game-changing feature is the flexible premium. Unlike whole life, where you have a fixed payment due every single month or the policy lapses, UL lets you decide how much to pay and when, within certain limits. You can pay the minimum premium, which just covers the cost of insurance and fees for that month. You can pay a target premium, which is what the insurance company calculates you'll need to pay to keep the policy going for your whole life. Or you can pay the maximum premium allowed by the IRS, stuffing as much money as possible into the cash value account to let it grow tax deferred. Imagine you're a veteran who just left the service and you're starting your own business. The first few years are lean. Money is tight. With a UL policy, you could choose to pay only the absolute minimum premium just to keep the death benefit active for your family. You're covered, but you're not breaking the bank. Then, 5 years later, your business takes off. You're making great money. Now, you can start overfunding that same policy, dumping in extra cash to aggressively build up your cash value. You can even make up for those lean years. That's a level of control you simply don't get with other types of insurance. This flexibility extends to the death benefit too. Let's say you have another kid. You can often apply to increase your death benefit. Or maybe your kids are grown, the house is paid off, and you don't need $1 million policy anymore. You can petition to decrease your death benefit, which in turn lowers your cost of insurance, allowing more of your premium to go toward cash value or simply letting you pay less. It adapts to your life, not the other way around. Now, let's talk about that cash value account because this is where the engine of a UL policy really hums. The cash value earns interest. In a standard universal life policy, this interest is declared by the insurance company. There's usually a guaranteed minimum, say 2%, so you know you'll never earn less than that. But typically, it will earn a higher, non-guaranteed rate based on the performance of the insurance company's own investments. Each month, the company deducts the cost of insurance and any administrative fees directly from your cash value. This is a critical point to understand. The premium you pay doesn't directly pay for the insurance. It goes into your cash value bucket first. Then, the company takes what it needs out of that bucket. As long as there's enough cash in the bucket to cover that monthly deduction, your policy stays in force. This is what allows you to skip premium payments. If you've overfunded the policy in the past and built up a nice cash reserve, that reserve can cover the costs for months or even years if you hit a rough patch financially. But there's a catch, a big one. The cost of insurance is not level. It increases every single year as you get older. When you're 40, the cost to insure your life for a month is very low. When you're 80, it's dramatically higher. If you only ever pay the minimum premium on a UL policy, you create a ticking time bomb. In the early years, everything looks great. Your cash value might even grow a little. But as you age, that rising cost of insurance starts to act like a ravenous parasite, eating away at your cash value faster and faster. Eventually, it can drain the account completely, and if there's not enough value to cover 1 month's costs, your policy will lapse. You'll get a letter demanding a huge premium payment to keep it active, and if you can't pay it, you lose everything. You lose the death benefit and all the money you paid in over the years. This is the great danger of underfunded universal life insurance. Because of this risk, the industry evolved. They created different types of UL to solve for different needs. The first, and maybe one of the most useful for veterans who just want a straightforward guarantee, is called Guaranteed Universal Life or GUL. Think of a GUL as term for life. It's a hybrid. It's built on a UL chassis, but it's designed to do one thing perfectly: provide a guaranteed death benefit at a fixed guaranteed premium, typically to age 90, 100, or even 121. To achieve this, it strips out almost all of the cash value accumulation. You're not trying to build a nest egg with a GUL. You are buying the cheapest possible permanent death benefit. For a veteran in their 50s or 60s who missed the boat on other coverage and just wants to make absolutely sure there's money for final expenses or to leave a small legacy, a GUL can be a fantastic, cost-effective tool without the high price tag of whole life. But what if you want that cash value growth potential? What if you like the idea of your policy's performance being linked to the market, but you're terrified of losing money? That brings us to the most popular and most complex version of UL today: Indexed Universal Life or IUL. With an IUL, the interest credited to your cash value isn't tied to the insurance company's portfolio. Instead, it's tied to the performance of a stock market index, most commonly the S&P 500. Now, your money is not directly invested in the market. This is not a 401k. Think of it more like the insurance company is watching the market and giving you credit based on what it does. This is where 3 key terms come into play: the floor, the cap, and the participation rate. The floor is your safety net. It's the absolute minimum interest you can be credited in a given year, and it's almost always 0%. This is the headline feature of IUL. If the S&P 500 crashes and loses 22% in a year, Your cash value doesn't lose a dime from that market drop. You just get a 0% return for that period. You're protected on the downside. The cap is the trade-off for that protection. It's the maximum interest you can be credited. So if the S&P 500 has a fantastic year and goes up 25%, but your policy has a 9% cap, the most you can be credited is 9%. You give up some of the home run potential in exchange for never striking out. Finally, there's the participation rate. This is the percentage of the index's gain that you actually participate in up to the cap. If it's 100%, you get the full gain up to the cap. If it's 50% and the index goes up 10%, you'd be credited 5%. So an IUL offers a fascinating proposition: the potential for market-linked returns without the risk of market-based losses. For a younger veteran who has a long time horizon and is comfortable with this kind of structure, it can be a powerful tool to build tax-deferred cash value that can later be accessed, often tax-free, through policy loans to supplement retirement or pay for major expenses. However, the complexity of IUL is also its greatest weakness. The illustrations used to sell these policies are based on non-guaranteed assumptions. The insurance company can change the caps and participation rates over time, which can dramatically affect your long-term returns. And that ticking time bomb of the rising cost of insurance? It's still there. An IUL must be funded properly and reviewed regularly to ensure it's performing as expected. This is not a set-it-and-forget-it product. It is a high-performance vehicle that requires a skilled driver. So, universal life in all its forms is about trade-offs. You trade the ironclad guarantees and simplicity of whole life for flexibility and control. With a GUL, you trade cash value growth for an affordable, permanent death benefit. With an IUL, you trade the unlimited upside of the market for downside protection. It's a powerful tool for the veteran whose life isn't a straight, predictable line. And let's be honest, whose is? We've talked about the main types of policies, the chassis of the car, so to speak: term, whole, and universal. But what about the options? The customizations? The things that take a standard policy and turn it into a personalized financial security tool, perfectly suited for your mission? We're talking about policy riders. The turbochargers, the living benefits, the things that can pay you while you're still alive. And that's exactly where we're headed next. Think of a standard life insurance policy as your service rifle. It's reliable, it does its primary job exceptionally well, and it's the foundation of your entire setup. But no one goes into a complex mission with just the basic rifle. You add optics for better targeting, a suppressor for stealth, a foregrip for stability. You customize it for the specific mission ahead. That's what policy riders are. They are the mission-critical attachments for your financial security plan. They transform a simple death benefit into a dynamic, flexible tool that can protect you and your family against a whole range of threats, not just the final one. These riders are the secret weapon of modern life insurance, and frankly, it's what separates a generic, off-the-shelf plan from a truly customized shield for your family. The most powerful shift in thinking is this: riders can turn your death benefit into a living benefit. Let that sink in. The money isn't just for when you're gone. With the right riders, you can access a portion of that money while you are still alive, during some of the most difficult times you might ever face. This isn't some gimmick. It's a fundamental evolution in how financial protection works. Let's start with the big one, the Accelerated Death Benefit Rider, or ADB. This rider is so fundamental that it's often included in term and permanent policies at no additional upfront cost. Think about that. A massive benefit for free. Here's how it works. If you are diagnosed with a terminal illness and a doctor gives you a life expectancy of, say, 12 to 24 months, this rider allows you to access a significant portion of your death benefit immediately. Imagine the power of that. Instead of your family receiving a check after you're gone, you get the funds now. What could you do with that? You could pay for experimental treatments not covered by the VA or your health insurance, giving you a fighting chance. You could eliminate all your family's debt, the mortgage, car loans, credit cards, so your spouse isn't left with that burden. You could use it to take one last incredible trip with your kids, creating memories that will last their lifetimes. You could prepay for funeral expenses, taking that emotional and financial weight off your family during a time of grief. This rider gives you control. It gives you options and dignity at the end of life, transforming a period of potential financial panic into a time of peace and preparation. It's the ultimate contingency plan. Now let's talk about a different scenario. What if you're not diagnosed with a terminal illness but a critical one? A sudden heart attack, a major stroke, an invasive cancer diagnosis. You survive, thank God, but your life is turned upside down. The VA might cover your hospital bills, but who covers the mortgage when you're out of work for 6 months recovering? Who pays the car note, the utilities, the grocery bills? Your income stops, but the bills don't. This is where a critical illness rider comes in. This rider pays you a lump sum, tax-free benefit if you are diagnosed with a qualifying critical condition listed in the policy. This is money paid directly to you, to use however you see fit. It's a financial first aid kit. It's the cash infusion that prevents a health crisis from becoming a full-blown financial catastrophe. You can use it to cover your health insurance deductibles, pay for specialized rehabilitation, or simply replace your lost income so your family can focus on your recovery, not on the fear of foreclosure. It bridges the gap between what your health insurance covers and what your life actually costs. For a veteran who might be the primary breadwinner, this rider isn't a luxury. It's a financial lifeline. Let's take it one step further down the road. What happens if you suffer an illness or injury that doesn't kill you, but leaves you unable to care for yourself? This is the domain of the chronic illness rider, which often functions like a long-term care or LTC rider. The statistics here are staggering. The median cost for a home health aide in the United States is over $5,000 a month. Assisted living? Close to that. A private room in a nursing home can easily top $9,000 a month. While the VA does have some long-term care benefits, they can be restrictive, with long waiting lists and limitations on where and how you receive care. A chronic illness or LTC rider gives you back the power of choice. If you can no longer perform 2 of the 6 activities of daily living, things like eating, bathing, dressing, or moving around, this rider allows you to accelerate or access a portion of your death benefit each month tax-free to pay for care. This means you can afford to hire an in-home nurse and stay in the comfort of your own home, surrounded by family. It means you can choose the assisted living facility you like, not just the one you can afford. It protects your spouse's retirement savings from being completely drained by the astronomical costs of care. It preserves your legacy for your children, instead of having it all consumed by medical bills in your final years. It's about maintaining dignity and control over your own life, no matter what health challenges arise. Now, those are the big 3 living benefits, but there are other, equally vital attachments for your policy. One of my favorites is the waiver of premium rider. It's brilliantly simple, but incredibly powerful. It's like insurance for your insurance. If you become totally disabled and are unable to work, the insurance company will waive your premium payments, but your life insurance coverage stays in full force. Think about the cruel irony. The moment you need life insurance the most, when you're disabled, can't earn an income, and your family is vulnerable, is the exact moment you can least afford to pay the premiums. Without this rider, your policy could lapse, leaving your family completely exposed. With it, your protection is locked in. The insurance company essentially pays the bills for you until you can return to work. It's a backup generator for your financial security grid, ensuring the lights stay on even when your income goes out. And for the younger veterans out there just starting your careers and families, there's the guaranteed insurability rider. This might be the most important rider you can get early on. It gives you the right to purchase additional life insurance coverage at specific dates in the future, like every 5 years, or when you get married or have a child, asterisk without asterisk having to prove your insurability. That means no new medical exams, no new blood tests, no new health questions. You are locking in your good health today to guarantee your coverage for tomorrow. What if you develop high blood pressure, diabetes, or even just gain some weight in your 30s or 40s? Those conditions could make new insurance drastically more expensive, or even make you uninsurable altogether. This rider makes that irrelevant. It's like getting pre-approved for a security upgrade for your family before you even know you'll need it. As your income grows and your family's needs expand, your life insurance coverage can grow with you, guaranteed. So you see, these riders aren't just fine print. They are the tools that allow a life insurance policy to adapt and respond to the real challenges of life. They are the living benefits that provide cash when you're fighting an illness, the waivers that protect you when you're disabled, and the guarantees that secure your future. They take a static plan and make it a dynamic, responsive shield. So we have all this incredible gear, all these powerful upgrades. The accelerated death benefit, critical and chronic illness riders, waiver of premium, guaranteed insurability. But what does it cost? Are you paying for features you don't need? How do you analyze the threat landscape of your own life to build the perfect custom loadout without breaking the bank? That's the critical intelligence we're covering in the next briefing. Alright, let's conduct this briefing. The first step in building any operational plan is intelligence gathering. But in this mission, the intelligence isn't about an external threat. It's about you. The insurance company is going to conduct a full threat assessment on your life, and the results of that assessment will determine your price, your premium. So, to get the best rate, you need to know what they're looking for before they even start looking. Think of it as your personal METTTC analysis, but for life insurance. Mission, enemy, terrain, troops, time, and civilian considerations. Except here the factors are age, health, lifestyle, coverage amount, term length, and riders. Let's break down the enemy's intelligence gathering process, what the underwriters are actually looking at. First and most heavily weighted is age. This is non-negotiable. Every year you wait, the cost goes up. It's a simple actuarial reality. A 30-year-old non-smoker is a much lower risk than a 50-year-old non-smoker. The probability of a claim being filed is just statistically lower. The takeaway here is simple. The best time to get life insurance was yesterday. The second best time is right now. Don't procrastinate. Locking in a rate when you are younger and healthier is the single biggest financial advantage you can give yourself in this arena. Next up is health. This is the big one. This is your personal readiness inspection. When you apply for a fully underwritten policy, you'll likely go through a medical exam. It's usually free, done at your home or office, and takes about 30 minutes. They'll take your height, weight, blood pressure, and a blood and urine sample. What are they screening for? Everything. Cholesterol levels, blood sugar, liver function, kidney function, and critically nicotine and drug use. Let's be direct about nicotine. If you smoke, dip, vape, or use any nicotine products, you will pay significantly more. We're not talking 10 or 20% more. We're talking 2 to 5 times more. A smoker's premium versus a non-smoker's premium is a night and day difference. If you're thinking about quitting, do it. Most companies will reevaluate your rate and move you to non-smoker status after you've been nicotine-free for at least 12 months, sometimes 24. That one lifestyle change can save you tens of thousands of dollars over the life of a policy. They'll also pull your medical records. They will look at your history. Pre-existing conditions matter. Things like high blood pressure, diabetes, a history of heart disease, or cancer will impact your rate. But, and this is critical, it does not automatically disqualify you. The insurance industry has evolved. There are companies that specialize in what they call impaired risk. They are more understanding of certain managed conditions. This is why it's so important not to just go to one single company. You need to shop the market, because one company might rate your specific condition much more favorably than another. The third factor is your lifestyle. This is the operational risk assessment. Do you have a high-risk hobby? Are you a private pilot, a scuba diver, a rock climber? You have to disclose this. Lying on an application is fraud, and if you pass away while doing that undisclosed activity, your family might get nothing. They also look at your driving record. A history of DUIs or reckless driving is a massive red flag. It tells them you have a higher than average risk profile. Your occupation can play a role, but for most veterans transitioning to civilian life, this is less of an issue unless you're moving into another high-risk field like logging or commercial fishing. So you have these core factors: age, health, and lifestyle. These determine your risk classification. Think of it like a PT score. You could come back as Preferred Plus, which is the top tier, the 300 PFT score. This gets you the absolute best rates. Then there's Preferred, Standard Plus, and Standard. If you have some health issues or lifestyle risks, you might get a table rating, which is basically Standard plus a certain percentage. For example, a Table 2 or Table B rating might mean you're paying the standard price plus 50%. Now let's talk about building your custom loadout. This is where you control the cost. The two main levers you can pull are the coverage amount, the death benefit, and the term length. A $500,000 policy is cheaper than $1 million policy. A 20-year term is cheaper than a 30-year term. The trick is not to just pick the cheapest option. It's to align the gear with the mission. If your mission is to protect your family until your youngest child is out of college in 22 years, a 20-year term policy might leave you dangerously exposed at the end. A 25 or 30-year term would be the correct strategic choice. If your mortgage has 28 years left, a 30-year term makes sense. Don't save a few bucks a month only to have your coverage evaporate right before you complete the mission objective. Match the term length to your longest financial obligation. Now for the attachments, the accessories on your rifle. These are the riders. Some are practically free and should be standard issue. Others cost extra and you need to decide if they fit your operational needs. The most common is the Accelerated Death Benefit Rider. This is a must-have, and it's usually included at no extra cost. It allows you to access a portion of your own death benefit while you are still alive if you are diagnosed with a terminal illness. This isn't for your family later. This is for you now. It can be used for experimental treatments, for travel, for getting your affairs in order, for anything. It provides dignity and options during the worst possible time. Next is the waiver of premium rider. This one costs extra, but for anyone who understands the reality of disability, it's worth a hard look. If you become totally disabled and can't work, this rider pays your life insurance premiums for you. Your coverage stays in force. Without it, if you lose your income due to disability, one of the first things you might have to cut is your life insurance payment, at the exact moment your family's financial future is most precarious. This rider ensures your safety net remains intact. Then there's the Accidental Death and Dismemberment Rider, or AD&D. This also costs extra. It pays out an additional death benefit if you die as the result of a covered accident. It also pays a partial benefit for the loss of a limb or eyesight. It sounds good, but be careful. It's a supplement, not a substitute. Most deaths are due to illness, not accidents. Some people see a cheap $1 million AD&D policy and think they're covered. They're not. It's a limited-use tool. For most people, it's better to put that extra money towards a larger primary death benefit that covers death from any cause. Finally, there's the child rider. This is a very inexpensive rider that allows you to add a small amount of term life insurance, maybe $10,000 or $20,000, on all of your children for one flat monthly fee. It's not about replacing an income. It's about having funds available to cover funeral expenses and take time off work to grieve without financial pressure. When a new child is born, they are typically automatically covered. It's a simple, affordable peace of mind for your whole squad. So how do you put all this intelligence together and get an actual price? You get quotes, but how you get them matters. You have two primary routes: a captive agent or an independent agent. A captive agent works for one company, State Farm, New York Life, Northwestern Mutual. They can only sell you their company's products. They are an expert on their gear, but they can't tell you if the gear down the street is better or cheaper for your specific situation. An independent agent or broker works for you. They don't work for an insurance company. They have contracts with dozens of different carriers. Their job is to take your personal intelligence brief, your age, health, lifestyle, and needs, and shop it across the entire market to find the company that will view your specific profile most favorably. If you have a specific health condition, an independent agent will know which of their 30 carriers is most likely to give you a standard or better rating, while another might give you a much more expensive table rating or even a denial. Working with an independent agent costs you nothing. They are paid a commission by the insurance company you ultimately choose, and that commission is already built into the price of the policy regardless of how you buy it. It is, in almost every scenario, the most effective way to survey the entire battlefield and ensure you are getting the absolute best coverage for the best possible price. You wouldn't go into a mission with only one source of intelligence. Don't go into buying life insurance with only one option. We've analyzed the threat. We've defined the mission parameters and assembled our custom loadout. We know how to gather market intelligence. Now comes the most critical phase: the application and underwriting process. This is where the plan meets reality. This is the obstacle course. What happens during underwriting? What are the common mistakes veterans make on the application? How do you properly disclose sensitive information from your service history, like a PTSD diagnosis or a TBI, without getting automatically denied? Navigating that minefield is the key to getting your policy approved and enforced. And that is exactly what we're going to wargame in our final intelligence brief. Alright, let's break down the mission. Your objective: secure a private term life insurance policy. The opposition: an underwriting process that sees a military service record not as a badge of honor, but as a collection of potential risks. The terrain is confusing, and the rules of engagement are written by them, not you. But you are not going into this blind. This is your operational playbook. First, you must understand your adversary's mindset. The insurance underwriter is not your enemy, but they are not your friend either. Their sole job is to assess risk for the company. They are a professional skeptic. They will see a diagnosis of PTSD, traumatic brain injury, or sleep apnea on your record, and their training will immediately flash red flags. Their calculus is simple. Does this person's history suggest a higher probability of an early death than the average person of their age and gender? Every piece of information they gather is filtered through that one question. Your job is not to fight them. It's to de-risk yourself in their eyes. It's to provide them with such overwhelming evidence of your current health, stability, and responsibility that saying no becomes the illogical choice. This is an intelligence operation, and it begins with reconnaissance on the most important target, yourself. Phase 1. Assemble your dossier. Before you even think about talking to an agent or filling out an application, you need to gather your own intelligence. You need to know exactly what the underwriter is going to see before they see it. This means you need to get your hands on 3 key documents. First, your complete VA medical records. And I mean complete, not just the summary. You want every note, every consult, every prescription. You need to read through it and understand the narrative it tells about you. Are there notes from a doctor 10 years ago that sound worse than the reality? Is a diagnosis listed that you've since recovered from? You have to know what's in there. Second, your civilian medical records. If you've seen any doctors outside the VA system, get those records too. A clean bill of health or a positive report from a private specialist can be a powerful counterweight to a grim-looking VA file. Third, and this is the one most people miss, you need to request your MIB report. MIB stands for the Medical Information Bureau. Think of it as a credit report for the insurance industry. Every time you apply for life, health, or disability insurance, a record of that application and its outcome can be logged in the MIB. If you were declined 10 years ago for a policy you barely remember applying for, it's in there. The underwriter will pull this report within minutes of receiving your application. You need to see it first to make sure it's accurate and to prepare for any questions it might raise. Once you have this dossier, you are no longer operating in the dark. You have battlefield clarity. You know your vulnerabilities and your strengths. Now you're ready for Phase 2. Phase 2. Select your force multiplier. You do not go on this mission alone. You need an asset on the inside, someone who knows the terrain better than you do. This is your independent insurance broker, but not just any broker. You need a specialist. You are looking for an independent broker who explicitly states that they specialize in working with veterans and high-risk cases. Why is this so critical? Because this person is your intelligence officer. A captive agent, one who only works for a single company, can only offer you one solution. If you don't fit in their perfect little box, you're denied. Mission failed. An independent broker, however, works with dozens of insurance carriers. They know which carriers are more lenient with well-managed PTSD. They know which ones have specific underwriting guidelines that are favorable to veterans with a sleep apnea diagnosis. They know which company will see a past TBI as ancient history, and which one will see it as a permanent red flag. This specialist broker will take your dossier, all those records you gathered, and conduct reconnaissance on your behalf. They can go to the underwriters at 10 different companies and present your case informally. They'll say, I have a 42-year-old Marine veteran, 50% VA rating for PTSD and tinnitus. He's been in stable therapy for 5 years, no hospitalizations, holds a senior management position, non-smoker. Here are the details. What kind of a rating are we likely looking at? This is a ghost operation. It leaves no trace. You get vital intelligence on your probability of success with different carriers without submitting a formal application that would be recorded in your MIB file if denied. This step alone can be the difference between a swift approval and a chain of denials that follows you for years. Phase 3. Execute the application. Once your broker has identified the most favorable carrier, it's time to fill out the formal application. Your guiding principle here is radical honesty, strategically presented. You will not lie. You will not omit. You will not conceal. Doing so is fraud, and if discovered, they will not only cancel your policy, they can refuse to pay the death benefit, leaving your family with nothing. You disclose everything, but how you disclose it is everything. The application will have a simple yes/no checkbox. Have you ever been treated for a mental health condition like anxiety or PTSD? You will check yes, but you will not stop there. In the space provided or in an addendum, you will provide context. This is your chance to control the narrative. Instead of letting the underwriter see PTSD and assume the worst, you give them the full de-risked picture. For example, yes, diagnosed with PTSD in 2016 following combat deployment. Have been in consistent outpatient treatment with Dr. Evans since 2017. Symptoms are well managed, and I have held my current position as a project manager for the last 6 years. I have had no hospitalizations or work interruptions related to this condition. See the difference? One is a scary label. The other is a story of responsible management and stability. The same goes for a TBI. Instead of just checking yes to a head injury, you provide the context. Yes, sustained a mild TBI from an IED blast in 2014. I underwent a full neurological workup upon my return, and a follow-up exam in 2020 with neurologist Dr. Smith confirmed no lasting cognitive or motor deficits. I have been cleared for all physical and work-related activities. You are preemptively answering the underwriter's questions. You are showing them that your past is not a predictor of your future. The most powerful tool in this phase is the cover letter. Your broker should help you draft a one-page letter to the underwriter that accompanies your application. This is your commander's intent. It summarizes your service, acknowledges the health issues in your record, and then methodically explains how each one is managed, stable, or resolved. It frames you not as a collection of diagnoses, but as a resilient, proactive, and responsible individual. It turns a stack of cold medical files into a human story. This letter alone can shift an underwriter from a mindset of reasons to deny to reasons to approve. Phase 4. The medical exam. Most policies will require a paramedic exam. This is a simple health screening. Your preparation is key. For 24 hours before the exam, avoid alcohol, tobacco, heavy exercise, and excessive caffeine, as these can temporarily skew your results. Get a good night's sleep. Drink plenty of water. When the paramedic asks you questions, your answers must be consistent with what you wrote on your application. Honesty and consistency are paramount. After the exam, the final phase begins, the wait. The underwriter will now review your application, your medical records, the exam results, your MIB report, and your prescription history. Because you did your reconnaissance and presented your case strategically, you have guided their hand. You have given them the evidence they need to see you as a standard or near standard risk. They may come back and ask for more information, what's called an attending physician statement, or APS, from one of your doctors. Do not panic. This is a normal part of the process. It's a sign that they are doing their due diligence, that they are taking your application seriously. Cooperate fully and quickly. This entire process, this mission, is about shifting the balance of power. It's about moving from a position of hoping for the best to a position of executing a well-designed plan. You are taking control of your own story and presenting it in the most favorable light, backed by honesty and documentation. Because the goal isn't just to get a policy. The goal is to get the right policy at the best possible price to protect the people you fought for in the first place. But what happens if, after all this, the offer comes back with a high rating or even a postponement? Is the mission a failure? Absolutely not. This is not a roadblock. It's a data point. It's critical intelligence that we can now use to adjust our strategy. Think of it like a mission debrief. We went in with a plan, we encountered unexpected resistance, and now we regroup and formulate a new plan of attack based on what we've learned. First, let's define the terms. A rating means the insurance company still sees you as an acceptable risk, but they believe you're a higher risk than the average person your age. So they'll offer you the policy but at an increased premium. This is often categorized with tables like Table B or Table 4, where each step up represents roughly a 25% increase over the standard price. A postponement means the underwriter isn't comfortable making a decision right now. They want to see more time pass. Maybe you just recently finished a specific treatment or changed medications, and they want to see 6 months or a year of stability before they'll reconsider. A flat-out decline is, of course, a no. So what's our new mission plan? Step 1. Interrogate the decision. Your independent broker is your advocate here. They will go back to the underwriter and get the exact reason for the rating or postponement. They won't accept a vague answer. Was it the combination of your sleep apnea and your cholesterol numbers? Was it a specific note in your doctor's records from 3 years ago? We need the precise intelligence to move forward. Once we have that information, we have options. The first is to appeal the decision with the same company. This is where your preparation pays off. We can submit a letter from your current physician clarifying your condition and prognosis. We can provide documentation showing your consistent use of a CPAP machine, or your new, healthier diet and exercise regimen that has your blood pressure under control. You can even write a personal letter, a statement of command, detailing your lifestyle and commitment to your health. Sometimes, this new evidence is enough to get an underwriter to reverse their decision or improve the rating. You are not a passive participant in this process. You have the right to challenge and provide context. But what if they don't budge? This is where the true power of using an independent agent comes into play. They don't work for one single company. They work for you. They can now take that application along with the decision and the reasons behind it and pivot. They can go to a dozen other carriers, but this time they're not going in blind. They can have informal conversations with underwriters at other companies, presenting your case up front. They can say, look, I have a 45-year-old Army veteran, 30% VA rating for tinnitus and a knee injury, takes medication for blood pressure which is well controlled. Carrier A wants to rate him table 4. What can you do for him? You'd be amazed at how differently insurance companies view the same set of facts. Carrier A might be terrified of a certain medication, while Carrier B has seen thousands of applicants on it with no issue and will offer a standard rate. Carrier C might have underwriters who are veterans themselves and have a deeper understanding of service-connected conditions. This is the shopping the market phase, but it's an expert-targeted approach. It's not just throwing applications at a wall. It's using the initial intelligence to find the carrier whose guidelines are most favorable to your specific situation. This process alone can save you hundreds, if not thousands, of dollars a year and turn a potential decline into an approval. But let's push this to the limit. Let's say, for whatever reason, a fully underwritten policy just isn't in the cards right now. Maybe your health conditions are too complex or too recent. Is the mission over? Is your family left unprotected? Absolutely not. We now move to our contingency plans. This is where we look at policies that require less, or even zero underwriting. The first level is called Simplified Issue Life Insurance. You've probably seen these advertised as no medical exam policies. And that's true, there's no nurse coming to your house, no blood draw, no physical. Instead, you'll answer a series of health questions on the application. They'll also check your prescription history and your MIB, or Medical Information Bureau report. Because the insurance company is taking on more risk by not doing a full medical exam, these policies typically have two trade-offs. The premiums are higher than a fully underwritten policy, and the maximum death benefit is usually lower, often capping out around $500,000, though sometimes more. But for many people, this is a fantastic solution. The process is incredibly fast. Sometimes you can get an approval in minutes or days, not weeks or months. It's a direct and efficient way to secure a meaningful amount of coverage without the hassle of a full medical exam. If even simplified issue isn't an option, there is one final safety net. It's called Guaranteed Issue, or Guaranteed Acceptance Life Insurance. And the name says it all. There are no health questions. There is no medical exam. There are no reports they pull. As long as you meet the age requirements, typically between 45 and 85, you cannot be turned down. Now, this sounds perfect, but it's critical to understand the trade-offs because they are significant. First, the coverage amounts are much lower, usually topping out at around $25,000 or $50,000. This isn't a policy designed to replace your income for 20 years. It's designed to cover final expenses, a funeral, medical bills, small debts, so that burden doesn't fall on your family. The second and most important feature to understand is what's called a graded death benefit. For the first 2, sometimes 3 years of the policy, if you pass away from natural causes like a heart attack or cancer, the policy will not pay the full death benefit. Instead, it will refund all the premiums you paid, plus a certain amount of interest, usually around 10%. If you die from an accident at any time, however, it pays the full face amount from day one. After that 2 or 3 year waiting period is over, the policy will pay the full death benefit for any cause of death. This graded period protects the insurance company from people who know they are terminally ill from buying a policy at the last minute. It's the mechanism that allows them to offer coverage to everyone, regardless of health. It is a last resort, but for someone with serious health issues, it can be an absolute godsend, providing peace of mind that their final expenses are taken care of. So let's zoom out. Over this series, we've gone from basic training to advanced strategy. We've dismantled the myth that your military benefits are enough. We've shown that VGLI, while valuable, is often a temporary and increasingly expensive solution. We've navigated the complex world of private insurance, understanding the difference between term, whole, and universal life. We've debunked the damaging rumors that a VA disability rating or a PTSD diagnosis is an automatic disqualifier. We've built a mission plan for a successful application, emphasizing honesty, preparation, and the absolute necessity of having an independent expert on your team. And just now, we've established contingency plans for even the toughest underwriting scenarios. We've covered the what and the how, but it all comes back to the why. Why do we do this? You spent your time in uniform focused on the mission, on protecting the person to your left and your right. You did it to protect our country and the ideals it stands for. This mission, the mission of securing life insurance, is no different. It's a direct extension of that service. It's the ultimate act of protecting your family, your team, your unit. It's ensuring that the life you've built for them, the dreams you have for them, are secure, no matter what happens to you. It's about making sure your spouse doesn't have to worry about the mortgage payment while they're grieving. It's about guaranteeing the funds are there for your kids' college education. It's about leaving a legacy of security and love, not a legacy of debt and worry. This isn't just a financial transaction. It's a promise written in ink and backed by a solemn oath that you will continue to provide for them, even if you're not here to do it yourself. Your final mission, should you choose to accept it, is to take action. Don't let this just be another video you watched. Use this knowledge. Have the conversation with your family tonight. Take the first step and contact a qualified, independent agent who specializes in working with veterans. The peace of mind that comes from knowing your family is protected is one of the greatest gifts you can ever give them. You stood a post for us. Now it's time to stand a post for them. Secure your legacy. Thank you for your service.